What we're going to talk about in today's video is using a whole life insurance policy specifically to generate income in retirement. So we're going to look at a case study based on an individual that we're currently working with. A little bit of information. This individual reached out to our company, interested in a whole life insurance policy, wants to maximize the cash value, but asked, what would it look like if I fund the policy aggressively for the next 20 years? You'll notice that she's presently in her mid-40s. She wants to fund the policy through the age of 65, and then after that, she wants to start taking income and at a heavy dollar amount as well. To provide a little bit of details on this, so we've got a 46-year-old female, age 46. She is a physician, so she's got the means to fund the policy quite aggressively. She's interested in the cash value benefits being a safe, liquid, tax-free area to position funds. She can access the cash value, but the goal here specifically is, again, income in retirement. So let's just call it retirement income. Have you ever heard of using a whole life insurance policy to supplement your income during retirement? A lot of people have, and a big reason why has to do with this word right here. So when I look at the cash value in a life insurance policy, if, this is a very important word, if we do everything right, we can access the cash value completely tax-free. So if you set up a policy properly, you can take income disbursements from that policy, you can take withdrawals, and then loan against the cash value without paying any loan interest, without repaying any loans, and you can get that money out completely tax-free. That's where the appeal often is with cash value life insurance when it comes to taking income from a policy and taking it income tax-free. Now, the specific numbers here, what she is interested in is as follows from a funding standpoint. So let's put funding in blue, income, we'll put in purple because we've got tax-free there. So for the next 20 years, what they want to see is $120,000 going in, $120,000 per year. Whether that's paid annually or $10,000 per month is completely up to the individual. She can change that as time passes, but that's how much they want to fund. And again, that's going to be for 20 years. So what we'll look at here is how much she's paying in annually, but what I also like to look at, I found this to be very effective, is the total funding. So think of it this way. If you're funding $120,000 per year, after 1 year, how much did you pay in? $120,000. If I asked you over 10 years, how much have you paid in? If you paid $120,000 every single year, you've paid in $1.2 million. What about year 7? Can you come up with that answer quickly? Some people can. What about year 15? My point is, having a total funding column, which simply shows the total dollar amount one has added to the policy over time, is very helpful because I can see how much I paid in, what my total cash value is. Why I like it is because it allows me to see what the total gain is. When do I break even? And then as time passes, how much more do I have in cash value than what I've actually paid into the policy? And here's the fun part here. So we're going to look at funding of $120,000 for 20 years, and then we'll look at income. Here was what was requested. $250,000 per year throughout retirement. Is that possible? Can you do something like this? Because when you put the money into the product, it will be compounding. So yes, you'll have gains there, but is $250K per year sustainable? We'll see exactly if it is or not. But what's beneficial about this is I can see what was my total funding, how much did I pay in, and then when I'm taking income, we'll also look at the total income. So now I can see over time what's the total dollar amount I paid into the policy, and then what's the total dollar amount I took from the policy in income, and how much more did I get out of the policy than what I paid into it over the life of the policy. Meaning from the day I started it, in my mid-40s, throughout retirement, up until the day I die. So we're going to look at all this, but you know what? Let's start with this. So we'll look at option A, because we're going to look at 3 different scenarios, all with the exact same policy. So this would be very, very beneficial if you are interested in a certain policy, but what you're interested in is not possible. What options can you progress through? So this individual wanted to see this. Fund the policy. So fund means what they're paying in at $120,000 per year for 20 years. And then income at $250,000 per year throughout all of retirement. So from 21st year onwards. So if that's not possible, what you're about to see, it is not possible. It will not sustain at that level. How long will it last? And what type of trouble will I get into as the client? I want awareness on that. And then I want to see an alternative or 2. If I'm them, that's what I'd like to see. The nice thing about this, it's all with one policy, just showing different income amounts when they retire. So this is a policy that's already been selected as far as here's the company and product that I like. I just want to see different income scenarios and exactly what I can and cannot do. That's what I want to understand, because we do not want to set expectations improperly, especially when it comes to taking income from a policy. And what I'll add real quick as a side note is looking at different assumptions, such as the guaranteed values and such, are very, very beneficial. I would check out the above video as we go through a case study of looking at one policy and then how much I can take in income based on the present dividend rate, but then also based on the guarantees. And then we also looked at an indexed rider assumption, but that's in the above case study. So let's look at this first, and then we will progress on to the different scenarios. So this is an illustration, some information here. We've got the formal illustration that we always would send to the client. That's very important to do from a compliance standpoint. This is just meant to simplify everything that we've got on Excel. So again, 46-year-old doctor, female, fund a policy at $120,000 per year for the next 20 years. So through the age of 65. Her last payment will be when she's 65, and then beginning year 21, which is at the age of 66, I'd like to take income of $250,000 per year every year. And what I plan on doing with this policy is using it for retirement. That's why I'm doing it. Okay, got it. Thank you very much for that info. So, income, $250,000 per year until, what do we have here? Policy lapse. So I'm going to explain exactly what's going on here with the lapse, and from an awareness perspective, this is one of my favorite words, awareness. If I'm aware of what's good and bad, I know not to pick the bad option or do the bad thing. So annual funding in blue. Then we've got the total funding here. So year 1, I've paid in 120, total funding 120. Year 2, I paid another 120. That brings my total payment up to $240,000. If I look at year 6, I have paid in how much? $720,000. There's my total cash value, $720,000 and change. And then it gets better and better as time passes. But the break even in this particular example is policy year 6. Now we can use a different version of this product to increase the break even or enhance the break even to year 5, between 4 and 5. But this policy is set up with a 10% PUA fee, and all that means is it's equipped for stronger long-term potential, potentially stronger long-term potential when we go with the higher PUA fee. But anyway, looking at this, here's the funding. So over 20 years, she pays in $2.4 million. And this is all based on the present dividend rate. Things will likely change. This is just a hypothetical illustration. What we want to show here It's the $250,000 per year. So here's your annual income. Let's take a look. And what do we see? Well, what I want to highlight first, well, let's do this actually. Annual funding column is in blue. Column to the right, we have circled here, is our total funding. So what we did here, when we start to take annual income of $250 per year, what happens to the total funding? It starts to go down. Why we set it up this way is because if this is me, what I'm interested in seeing is how much did I pay in, then how much did I pull out. So as we pull $250K per year in this example, eventually this goes into the red. And what this represents is the fact that I got my $2.4 million out, the money I paid in, and then whatever in red is that much more. So if I look at age 85, the total income in purple is $5 million. But what happened here, of that $5 million, 2.4 was the money I paid in, and then the rest, the other 2.6, that would be the gains on the life insurance policy. And how we ran these income illustrations is as follows. Taking withdrawals up to our cost basis. If you're not familiar with that term, basis equals the money you paid in. So in this example, the cost basis would be the $2.4 million, the 120 for 20 years. That's the money you paid. And then everything above the basis, that's the gain. So in this example, we pulled out an additional $2.6 million. Looks good, right? What happened? As we're taking income, the cash value is dropping. Oh, I forgot to close out this point. We take withdrawals up to the basis. If we continue to take withdrawals beyond our basis, that's going to trigger taxes. We'll have to pay ordinary income tax on that. So what we do, once we hit our cost basis, then we begin to take out loans without paying any interest or any loan principal. Now you can pay it, but in most examples, when we're looking at income, we do not do that. And that is reflected in the full illustration, which we would go over with anyone that we're working with. Again, the Excel workbook is meant to simplify this because there's a lot going on here. So here we go. Cash value is quite low, about $90,000. The death benefit has also come down over time. Now, what do you notice about age 86? We punched in $250,000 for income in this illustration. We couldn't take that much because we didn't have $250,000 in the policy. Here's the danger with this. Let's scroll down a little bit more. And an illustration will display this as well. We'll see this in the after-tax outlay column, which is the premium column. It assumes we're paying money in, where it's going to call for more premium. If we have a situation like this, what the company's software is telling us is that we need to pay that premium or this dollar amount, which can be the premium or the loan interest. If we don't, the policy will lapse. And if it lapses, we have a very, very large tax bill in this particular case, which you can look at the above video for information on that. So the main thing we want to look out for here is to make sure that when we prepare these illustrations, it's not calling for income. And the thing that I really like to do, this is more so information the agent needs to be aware of, is run these income illustrations with the current dividend rate, if that's what you're using, but then look at the guarantees, or at the bare minimum, look at a conservative dividend. It's very beneficial to see that because then you can forecast it to a degree. If dividends go down or if the policy underperforms for whatever reason, does it call for money? Because the last thing anyone wants is to have to call a client or inform them when they're in retirement, they have to take less in income or they're gonna have to pay money in to prevent the lapse and a huge tax bill. It's like, no, 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 we do not want that. And you can prevent that just by setting expectations properly. Where people get into trouble with this sometimes, and again, this is from the agent standpoint, is when illustrations are produced to show the best possible income scenarios. Wow, look at all this money I can take. That might be the case on an illustration right now, but it might be unrealistic in my opinion. And then when reality hits, the person thought they could pull 250, and then it turns out they can only pull out 150 or 170 without ever being told that. Therein lies the problem. But anyway, this was option A. So what do we have here? He was able to, or she was able to take income of $250 per year through age 85. Then at age 87, she has to pay money or it lapses. Age 87, pay or lapse. And in this case, and tax. We don't want a lapse and a tax. No, thank you. All right, so option B is as follows. We're going to look at the exact same funding. Then we've got, here's the difference with the scenario, income at $250,000 per year. Stop to prevent lapse. So what we're going to do is see how long we can pull $250,000 per year, beginning at age 66, without triggering a lapse, meaning we're going to stop the funding earlier than what we've got in the first example. So the first example, we took $250K as long as we could until we ran into a problem. At age 86 and age 87 was the problem. So now what we're going to look at is this. Same thing from a funding standpoint, exact same policy. Same thing here with $250,000 per year coming out. But what's the difference? Look at this. See that? What we've got going on here is we stop the income early. And the purpose of this, stopping the income, in this example at age 84, was to leave enough cash value in the policy in order to prevent a lapse from ever occurring. Now you'll notice we're not paying anything in. We're not taking any income out. What's happening to your cash value? It's decreasing. Why does that happen? That would happen if the loan interest exceeds the earnings on the policy. The dividends and interest is what I'm referring to when I say the earnings. The loan interest is exceeding that. However, what we look at here, how quickly does it drop and how low is it at age 100, and even afterwards for that matter. But in this case, we've got enough left where we even have a couple of years bought as well, meaning if dividends went down, this will last a few years before it lapses. So we're safe, in my opinion. But how we made ourselves safe is we pulled out a total of $4.5 million, which means when we look at the total funding, we got our $2.4 million back and then pulled out an additional $2.1 million. So that's nice because we got out the $250,000. However, what's not nice about it? Would you want this? What if you live beyond age 83? You still want to take income from the policy, right? Yeah, of course. So the third and final option we looked at was the same thing with respect to funding the policy at $120,000 per year. But here's the difference. Income, you want to see what's the maximum amount we can take throughout retirement until I die without the policy lapsing. And you'll notice it's right around $190,000 per year. So let's look at that. And here we go. So same policy. You'll notice all three of these are identical while we are funding it. But then afterwards, take $190,000 per year. Look at that. Does it lapse? No. We took income through age 95. Now, if we wanted to run this through 100 or longer, what we would do is kick the annual income down a little bit to perhaps $170,000 or $180,000. We could even look at it more conservative by reducing the dividend or looking at the guarantees, which would call for a more conservative number. But what we aim for here is to show an alternative as to what you can do if you wanted the income to last longer. So these are the different options. What I'll add, and we'll close with this as a bonus scenario. So we're going to call this, not D, we'll call it the bonus, is this. What if I still wanted $250,000 per year in income? Meaning, if this is really what I want to be able to generate this every year in annual income from the policy. How much, specifically this question comes up, how much do I need to fund the policy in order to ensure I can pull this much out per year beginning age 66? So we did run that as an option as well. And instead of funding the policy at $120,000 per year, what that called for was funding it at $160,000 per year. So on the far left, I don't really need to look at that. That's the same $120,000 per year option. But then we've got the $160,000 here, what it looks like if I don't touch it. And then the same thing, but with income. And this one, we've got some cash value left over. You know, when we look at any income scenario, whether you're looking at big dollar amounts like this, $250,000 per year in income, or if it's $25,000 per year in income, the most important thing is to properly set expectations. And how that is done, the question to ask your agent is this: can I see income based on a conservative dividend? You can use this term, a midpoint dividend. I would ask that question. If you really want to go conservative, I would ask, can I see income based on the guaranteed rate or guaranteed values? That's extremely conservative. If you look at that, it's likely going to do much better than that based on everything we've always seen with properly designed policies, with the major mutuals and the stuff we talk about all the time. But if you're conservative by nature and you'd like to see that, remember that it's your money and it's okay to ask. A lot of times when problems pop up is because we didn't ask the right questions, and a lot of times we didn't know what to ask, so we really can't be blamed for that. But if we have awareness on what's possible to be illustrated from an agent's perspective, that allows us to ask the proper questions. So when looking at income, if you said, hey, I'd like to be able to take $250,000 per year in income, here's how much I want to fund the policy with, can I do that? Show me an illustration where I can see that. On that illustration, I'd like to see everything based on the current dividend interest rate, but then can I also see it based on a conservative dividend rate and then also the guaranteed values? That way I can see the assumptions based on what I'd like. And then if it's not possible, you can ask for alternatives. What I usually like to do in advance is show some alternatives, because I would like that if things were flipped, to say, okay, what you're asking for is not possible, in a very nice way. However, a lot of people think that it's perfectly fine. Here's an alternative that gets you as close as possible. What are your thoughts on this? Would you like to see any adjustments here? Here's how much more you would need to pay in, or here's how much less you can take in income. I'm going to stop talking now because I'll keep talking about it because I really enjoy this topic. Let us know if this was helpful. If you have any questions or comments, please leave them below. I do appreciate you watching the video all the way through. If you'd like to work with us, please check out our website, ibcglobalinc.com. And as always, I hope this helps. Thank you so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.